Welcome back. Time to get into that post-analysis of that monetary policy committee meeting that we've just heard from with Reserve Bank Governor Lesetja Kganyago. And to do that, we're joined by three of our experts, Sifiso Skhinjana, who's the chief economist at IQ Business, Johan Els, who's an economist at Old Mutual, and of course, Nikki Weimer, who is the chief economist at Nedbank. Nikki, let's start off with you. What did you make of the Reserve Bank's statement this afternoon? Generally, when we hear, statements from the Fed Reserve, we listen out to tone and certain words that may have changed here and there. What did you make of this one?
I think it's very much a replay of the previous version. The more interesting bit, I suppose, or the previous meeting rather, the more interesting bit for me was their interpretation of the economy. They acknowledged that the first quarter was stronger than they would have thought. And they then pointed out that the recent riots have largely nullified that upside created in the earlier part of the year. And that left their forecast for GDP for this year unchanged. Interestingly, we had a different view on it, but we come up with exactly the same GDP number. So they left the GDP number unchanged. And then I think the tone here really is, I sense a bit of a struggle. I don't know, I might be wrong. You've got very muted inflation numbers. You've got a recovery that is underway, but is being sort of constantly disrupted by the fact that you still have COVID circulating in the population. You have recurring lockdowns. This is probably going to continue until we've reached herd immunity. And at the same time, you've now had these riots and unrests and just generally the mayhem and anarchy of July. And so that means that your recovery isn't as robust as you would like. It's going to take a time just to get back to 2019 levels, which means you're sitting with an output gap. You're also sitting with employment not recovering as fast as your overall GDP. And yet at the same time, you've got global dynamics that might require you to normalize monetary policy, but your fundamentals, being growth and inflation, doesn't really provide you with a strong case to start normalizing monetary policy. So it seems to me they're a bit torn. They're saying even when they start hiking, monetary policy will still be very accommodative. And they provided that same message at the last meeting. So I think there's a bit of a struggle going on there.
Sifiso, let's get your thoughts on it. I mean, what did you make of it? And did you also get that sense of that struggle that Nikki just mentioned?
No, absolutely. I think, the governor really speaks to the expectation of borrowing costs certainly continuing to be seeing those bond yields steepening. And so that's one of the things that they certainly think that is going to remain a constraint for the context of our country. And I think also there's an interesting point that they're saying a lot of the inflation drivers are cost push factors. So they're not demand-led in the context of our economy. And so there's really no demand pressure coming in. And that's probably also why they expect that inflation will remain muted in the context of this in the following year. I think what's certainly even more interesting is their outlook, I think, on economic growth. And particularly, I think, what's going to happen around the surrounding economies around that. I think the governor certainly has spoken to the fact that, as I said, that the riots have diminished the impact of the gains that they got in the first quarter. But I certainly don't think that they should be as bullish from an economic point of view. We're seeing certainly, in terms of the quality of the tax base now continuing to dwindle compared to where we were. We're seeing that corporate income tax is also dwindling, and also now then there's a pressure point from personal income tax to basically fund the economy. And so if you've got all of these organizations not being at the right level of profitability and your borrowing costs are rising, where are you going to generate the requisite levels of growth? And these are all the things that certainly are not coming out also around our growth expectations coming from the Reserve Bank.
All right, Johan, let's move on to you. What did you make of that speech? And did you find anything interesting on that front?
Yes, it was exactly as most of us expected, that they would keep rates unchanged this time around. And I think the uncertainty that's around, given the recent unrest that we have seen in terms of the impact on growth and the potential impact on prices. But what was interesting for me is the fact that they kept their growth forecast for the next few years, for 2022 and 2023, unchanged. In other words, they didn't see a lasting negative impact from what has been happening recently in terms of COVID lockdown or the recent unrest. And I think that's interesting. But in terms of the future path of interest rates, I think they do indeed want to normalize interest rates, even though that word normalize, I don't think it will get back towards previous pre-COVID levels pretty soon. But they feel that need to start the upcycle. But at the moment, as my colleagues have said, there's no urgent need for that, given where inflation is, given where inflation expectations sit, and given the uncertainty regarding the sequential growth numbers that we're probably going to see over the next while. And we also realize that confidence might have had a hit as a result of recent events. But then, it's also crucial to remember that the inherent structural strengths of the SA economy in terms of conservative policymaking, independent Reserve Bank, and they're working very hard on that independence in terms of policymaking, the independent judiciary, all of those structural benefits are still with us. And investors are not going to easily forget that, despite maybe some short-term impact in terms of confidence. So I think a very balanced statement, and clearly a need to start preparing markets that interest rates will have to go up in the future, but I don't think that's very close. I still think that might only happen from next year onwards, and then it's going to be a slow and steady upward path.
Johan, I want to stay with you on this one because you mentioned that you were quite surprised that they left their growth outlook for 2022, 2023 unchanged. What was Old Mutual's house view on the growth outlook for those 2 years?
Yes, I'm also expecting in a range of 2 to 2.5% going forward, which is, of course, better than what we've become used to over the previous 5 years to 2019. So we've had the declining growth path. Annual average growth over the 5 years to 2019 was just 0.8%. And if we try and ignore the COVID-interrupted years 2020 and 2021, then the medium-term outlook from next year onwards should be better, given all the policy changes that's in place, better energy, the rate of change regarding COVID in vaccinations, the rate of change regarding load shedding, policy changes, etc. That's all positive. So we should see better growth outlook. So I'm happy that they kept those rates unchanged in the 2% plus range. And although we realize that growth around 2 to 2.5% isn't great, we need more than that. But it's far better than the 0.8 annual average growth that we've had in the 5 years to 2019. So we're moving in the right direction, at least, even if it's not fantastic growth that we foresee.
Nikki, let's come to you. I want to talk about the slower pace of vaccinations that the Reserve Bank governor spoke about, especially for the emerging markets. Earlier this week, we did see, Asian markets and European markets basically seem to be concerned about these variant or rather COVID-19 flare-ups that we're seeing in various parts of the world. What's concerning you about what is happening right now, especially as we see these COVID cases continue to increase?
Yeah, I think that we will probably see an extended third wave as a result of the riots. So you'll see over time numbers already, to some extent, that is visible in the new cases. But here's the thing, we do know how to control this, right? We have come down this road, and to government's credit, I think they have learned to target restrictions more effectively, where you get the best health outcomes without completely slaughtering the economy. So what we've seen in both the second wave and in the third wave is that the economic impact has not been nearly as destructive as all the versions of lockdown we experienced in 2020. So I think that would continue. We will continue to be exposed to future waves of COVID, and partly because our vaccination process has been so slow. The looting and the unrest we've had over the past week obviously have slowed things down even further. We do know that they've moved quite quickly in getting vaccination stations open again. But of course, it's more than that. You need people to feel safe enough to venture out, to go to the vaccination center and get their jab. So hopefully we'll get to that point, and we'll gain momentum again. But this has clearly disrupted it. But I think generally speaking, South Africa is lagging behind. We're even lagging behind some of our peers in terms of the vaccination rates. And for us, herd immunity is not something we're going to achieve this year. I think we would have done well if we achieve it during the course of next year. In terms of the Delta variant, what is very clear from all the evidence I've seen of late is that it is dangerous, it is more contagious. If you've been vaccinated, there's no guarantee that you won't get the Delta variant of COVID, so you could actually get the illness. But what is very, very clear is even though infections are climbing in Europe and the US, it has been, you catch it easier if you are not vaccinated, and you wind up in hospital if you are not vaccinated. So the vaccines seem to be working where the world wanted them to work, and that is to prevent serious illness.
All right, Sifiso, let's turn our attention to you now. Based on what Nick has just mentioned, the concerns around the Delta variant and, the slow pace of vaccination, what's the impact on the economy, especially those sectors that rely on tourists that are in the leisure space, entertainment also, but there's also other smaller sectors that are affected with regards to this extended lockdown that we're in and a possible extension of this third wave?
Yeah, thank you. I think, certainly, firstly, the sectors that are high-touch sectors that require people to be mobile, and those are largely the informal sectors. And so a lot of the people who would have been trading in those sectors aren't able to trade as freely as they would be in personal care sectors, as well as some limited movements in terms of also commuting. We know that on average, households in South Africa spend somewhere between 15 and 25% on transport. And so if you don't have as much movement, there's also a pressure point from that particular sector. And I think that's certainly going to be something that's going to continue. Second is around, I think, the youth challenge, right? And we've seen that hospitality sector as well as construction are the kind of sectors that tend to employ relatively young people, as well as the creative industries as well. And so we've got a youth challenge in South Africa, and then we've already got an environment that constrains the very sectors that employ these people. And I think that's going to continue exacerbating the social risk that we are seeing. And of course, then there's also the kind of the political backdrop that's waiting, right? We've got local elections also sitting on the back end, and therefore that's also going to probably result in us having a revised season of the strike seasons that we've seen, because it tends to follow in election season. And so all of these things are certainly going to continue to be pressure points, I think, on one, our ability to recover more sustainably, but two, our ability to actually truly, kind of work down the kind of socioeconomic risks that are embedded in the economy. And I think those are some of the things that we certainly need to put a lot of emphasis on right now. Even in the support that we're putting in, we've got to make sure that that is actually building in from an industry capacity point of view, because that's where also some of the jobs will come back compared to in terms of where they have been lost already. And so we've really just got to also, I think, bring in a socioeconomic sustainability lens to this, to kind of where we are, and understand that that's exactly going to be one of the things that's going to slow us down in terms of growing sustainably where we need to go.
All right, Svi. So there are other, things that we want to talk about before we get, to the end of our discussion. We also have an ad break coming up, and there are various things that I want to discuss before we get to that ad break. Investor confidence, job creation. Svi was talking about ways in which we could support the economy. But I also want to talk about, household expenditures, Svi. So let's stay with you for this one. Was your outlook on that unchanged as well?
Yeah, I mean, if you actually just look, and so what's happening now, one with load shedding is certainly going to continue, putting pressure on households. Households are spending quite a sizable chunk as well on their income in terms of household, in terms of the living expenses, particularly in terms of rates and taxes, as well as electricity costs. And so we're seeing that Eskom, for example, continues through, to apply for these out-of-cycle expenditures that they incur by burning diesel, etc. And that's exactly what's resulting in all of these increases that we're seeing from an electricity point of view. And that's putting pressure on already a wage context in households that's not picking up as well at the same pace as the employment is picking up. And so we've also seen in the past that wages don't recover at the same pace as economic output. We've also seen an economy where we do get jobless growth. And so already we know that the household wage context is certainly going to be more muted than what we're going to see from an economic growth point of view. We know our GDP is a function, 60% of it comes from household expenditure. And so I think that's also something that we really need to look at, particularly as a particular pressure point from households, not only because, as I said, job security is now a pressure, but also because of also the rising input costs.
All right, we're going to take a quick ad break and continue with our conversation with our guests, Spisos Kenjana, Nikki Vaima, and Johan Els. We'll be back shortly.